Welcome to Bloomberg Markets. I'm Katie Greifeld. You have the S&P 500 climbing towards a fresh record. This would be its 46th this year. So let's get a quick check on these markets. Of course, you can see we're having a pretty good start to the week. The S&P 500, the Nasdaq 100, both higher to the tune of 7 to 0.8%. Of course, continuing that record run that we've been on. I can't say the same when it comes to crude right now. Of course, crude currently below $74 a barrel, down by about 2.3% on the day. Totally different story if you take a look at Bitcoin. Of course, risk appetite back in a big way, at least when it comes to the crypto space. Bitcoin currently higher by about 4.6%. Meanwhile, let's get some midday movers on the equity side. We'll do that with Bloomberg's Abigail Doolittle.
And we'll be taking a look, Katie, at a moment in one of the individual stocks that's at a record high. Right now, though, let's take a look at B. Riley Financial, soaring up 26%. The beleaguered financial firm trying to cut debt, and as a result, they have sold the bulk of their holding in its Great American Holdings to Oaktree, which is known for buying distressed debt and other pieces of the capital stack. For this, they've received $203 million. They'll also receive a 47% stake. Again, these shares soaring. To the downside, though, we have some weakness in the industrial space. Particularly, Boeing is down. It seems as though the airplane maker really cannot catch a break. Those shares are down about 1.5%, actually off the lows, down 1% at this point after announcing a 10% global workforce cut. They also took a $5 billion charge, this amid a very painful strike. Caterpillar down as well, down 1.7%. Let's end on a bright spot, though, and that is Wells Fargo, trading at an all-time high, up 7 days in a row, gaining 15% over this time period, the longest winning streak going back to May. And of course, Katie, last week they put up a good quarter where they actually, I believe it was sales that they missed slightly, but they beat earnings. And very impressive was the investment banking line. Clearly, investors liking that quarter and what they're seeing in Wells Fargo.
All right, Abigail Doolittle, thank you so much. Let's switch gears here because a shakeup is brewing over at Southwest Airlines. Activist investor Elliot Management has called for a special shareholder meeting at Southwest, officially kicking off the firm's first U.S. proxy fight since 2017. Now, Elliot has said that Southwest has shown years of underperformance and is now calling the meeting so that its fellow investors can vote on a raft of new board nominees. Elliot, of course, has nominated 8 directors to the Southwest board, seeking to replace 8 incumbents. For more, we're joined now by Bloomberg's Crystal C, who has been closely following the ins and outs of this one. So 8 nominations for board, of course. Seems pretty aggressive here. What has Southwest's response been?
So Southwest actually had just put out a statement. This is hot off the press, and they're saying that they have actually made every single effort that they can to reach a constructive resolution with Elliot. And actually, I'm sure Elliot would probably say the same thing. Most of the time, Elliot, activist investors don't want to fight, investors don't want to fight, and then the company don't want to fight. And somehow, like, we've reached this point where there is going to be a vote where Elliot called a meeting for December 10th, which is an out-of-cycle meeting, and they're trying to get 8 of their directors on the board and replace 8 of the existing directors.
And give us some context here, because if you go back to July, for example, we know that Southwest had gone forward with a poison pill of sorts to try to prevent Elliot from sort of launching this proxy fight. That obviously didn't work. What can Southwest do between now and December 10th?
So this story actually started in June when Elliot disclosed that it has a sizable position, and that stake wasn't a swap, and then now it became like equity. And when Southwest puts in that poison pill, it is to prevent Elliot from buying more shares, to prevent a hostile takeover, but also to prevent Elliot from like gaining more control, gaining more of the company. So from here on, what is going to be really interesting is if we look at the top 10 shareholder registry, you see a lot of passive investors, and these they don't tend to like make their voices known until the very end of any given battle. So from now on, what they say or what they kind of signal in the background would be very interesting to watch.
And it's interesting, shares are down a little bit today, about 1.7%. But Elliot said that Southwest has shown years of underperformance. And looking at the stock market, there exactly right. You take a look at Southwest. Over the past 5 years, down 41% on a total return basis. The S&P 500, for context, up about 114% over that time. So there are the numbers. What exactly went wrong at Southwest, would you say?
So also, like, the more important thing is looking at their rivals, such as like Delta, like JetBlue, like United. They're also trailing peers. Like United and JetBlue are up 50% in the past year, whereas Southwest is up moderately. Well, you know, it's good, but it's like 20%, which is like a big underperformance comparing to its peer. One of the things that Southwest has announced is a buyback, as well as ending its free seating policy, which is one of those kind of like hallmark of the Southwest Airlines. So these is like kind of moves to kind of premiumize and kind of tap into the more like business travelers and trying to like give a different price point option. And I think all of those is in some way to like trying to maximize profit, but also with the back in the back of their head, Elliot has been there since June. So whatever they do is now under a microscope from now until whenever the meeting is going to be.
Well, I know that you'll be one of the reporters following it very closely. Really appreciate you taking the time to speak with us. That, of course, is Bloomberg's Crystal C. Now, earlier today on Bloomberg Surveillance, the CEO of Stellantis spoke from the sidelines of the Paris Auto Show. This comes on the heels of a company leadership shakeup that will see the CEO exit from the company in 2026. He spoke about the EV sales slowdown here in North America.
In North America, we have a very specific problem, which is a very operational problem, not at all rocket science. In North America, we got trapped by a marketing plan on the second quarter of 24 that was very audacious, very daring, and it didn't work, it failed. So we got trapped by that marketing plan, and then we needed some time to discuss the best way to rebound with our US dealers, which we did. I did it personally in August this year. Now we have a new, let's say, more conventional plan that is active, and it's working very well. Over the last 3 months, we could reduce our US dealer inventory by 52,000 vehicles. And we will be, before the end of this year, before Christmas, below the ceiling of 330,000 vehicles, which we consider is the ceiling for a normalized inventory. This problem is now being fixed. It's not rocket science. We have discussed it with our dealer body. I think we have the right dynamics right now, and we expect this to be fixed this year. So that was what happened. Regarding the brands are very healthy. The Ram brand, the Jeep brand, with all the new models that we are bringing, the Dodge brand, but also very soon the new Chrysler models. I think they are very healthy. We just need to do a proper operational work in terms of way to go to market and collaboration with our dealers. I think we have the capability to do that, and I believe that Ram and Jeep are already leading the way in terms of the market share recovery that you can see as we improved our market share between September and July from 7.2 to 8.0%. So market share is up, inventories are down, they will be normalized by Christmas, and I think we are back on a quite nice trend, but now we need to deliver the results. This is what our investors and the community of investors expect from us.
Carlos, are you open to selling any brands?
Not necessarily. I'm not necessarily open on that. Of course, we consider any offerings or any proposals like in any open-minded business team, as we consider we are. So if there are proposals, we'll study, but we are not seeking any sale of any of our brands right now. That's very clear.
Because last time we spoke, you talked about corrective action. You've got a mandate until, I believe, the end of 2026 as the CEO of this company. I shared some of the details, the stats on the overcapacity across the European auto manufacturing sector. You're familiar with them. They're worth repeating. Nearly a third of the major car plants from Europe's Big Five are producing half the vehicles they have the capacity to make. And I'm sitting here, Carlos, just wondering, when are we going to make the decision to make the corrective decisions that seemingly need to take place? One of two things needs to happen. Either you cut capacity or European politicians, governments are going to come out with the right kind of demand-side incentives to buy the vehicles, because that's not there right now. When do we actually face the reality check? Is it this year? Is it next year? How much longer can we hold on with excess capacity?
Your comment is very valid. It is quite clear that right now we only ask two things to the governments, and specifically the European governments. We ask stability of the rules. We do not ask for any kind of postponement because we are ethically committed to contribute to fixing the global warming. So we don't ask for any postponement. We ask for stability from one side. And from the other side, we ask the governments to stimulate the demand, which is not to help Stellantis, but to help the consumer so that the consumer can buy EVs at an affordable price.
And that, of course, was Stellantis CEO Carlos Tavares speaking with Bloomberg Television earlier today. Now, coming up on this program, major banks reporting earnings tomorrow. Will markets like what they hear? Our preview is next. This is Bloomberg. All right, welcome back to Bloomberg Markets. I'm Katie Greifeld. It's time now for our stock of the hour, and great news. Instead of one stock today, we're looking at major banks broadly. You can see the KBW Bank Index rising over the past week amid strong earnings reports. Of course, we have Wells Fargo leading the upward move in that index, which is at its highest level since 2022. For more on this, I'm pleased to say we're joined now by HSBC Head of U.S. Financials Research, Saul Martinez, who covers the big names. And I want to start with net interest income. And I want to talk about J.P. Morgan, because I thought that Daniel Pinto told me last month that basically NII wasn't going to be so great. J.P. Morgan comes out, surprises on the upside. You saw this big run up on Friday. Are you expecting more of the same when it comes to its peers?
Thanks for having me. I think, Katie, it's about expectations. In fact, J.P. Morgan on Friday didn't say anything different than they said about a month ago. They did suggest that analyst estimates of $87 billion of net interest income, which is a pretty material decline relative to the $91.5 billion of core net interest income they expect this year. That is a material contraction. But there's light at the end of the tunnel, and I think that is what's going to be present in the results of the other banks. So in the case of J.P. Morgan, there's more pressure than maybe some other banks. But what Jeremy Barnum, the CFO, indicated is that they do expect net interest income, or they think net interest income could find a floor in the second quarter of next year. I think what you saw with Wells Fargo, who you indicated is performing very well, they had a tough net interest income quarter, but see stability going forward. And the underlying trends that are driving that are a couplefold. One is the deposit pricing pressure that we have seen does seem to be moderating. There's less yield-seeking activity from depositors, so you're seeing less pressure on deposits. And fixed assets, so think about auto loans, securities that were invested in at very low rates, those are repricing to higher rates. So you're getting that tailwind from the medium to long end of the curve that is helping asset yields. And I think that is going to be present in the results of the other banks who will start to report tomorrow again.
Yeah, and among them is, of course, Goldman Sachs. And this is another case where you had CEO David Solomon warning last month that trading was on track for a 10% drop for the quarter. He did suggest, of course, stronger investment banking gains could maybe help offset that. But when it comes to Goldman specifically, when it comes to the trading picture, what are you expecting, Saul?
I mean, we're expecting something similar to what David indicated at an investor conference about a month ago, down 10%. Both sequentially and year on year. Now, we have seen, good engagement in the markets businesses. Equity prices have been performing well. And if you look at, J.P. Morgan, they did outperform on Friday relative to the expectations they gave about a month ago for markets. So we wouldn't be surprised if that trend continued with the other investment banks as well. But for now, we're expecting about a 10% sequential decline, 10% year-on-year fall, which is a little worse than what we're expecting for some of the other investment banks. We would say for investment banking, as you indicated, a little bit better. We're expecting 15% year-on-year growth in IB. Again, J.P. Morgan strongly outperformed on IB relative to the expectations they gave. So to the extent you saw late quarter activity helping debt, capital markets, and M&A fees, perhaps that could translate into Goldman's results and the other banks' results as well.
Yeah, so something to keep an eye on, of course, as we look to Goldman. Let's talk about Citi, too, because that's an interesting story. You think about all the job cuts that Jane Fraser has put through, and it's interesting. If you take a look at the guidance, basically set to report lower personnel expenses for the second quarter in a row. How does that fit into the broader picture of Citi at this juncture?
Yeah, I mean, Citi, we like Citi. We are recommending Citi. Citi is a self-help story. Citi is a story, an investment story that relies on them improving profitability across their businesses materially over the next few years from a low base. And a really important part of that is, the expense line. They're expecting expenses this year of closer to $54 billion. I think it's 53.8 to be specific. But they've indicated that their medium-term target, i.e. 2026, they want to be in that $51 to $53 billion range. So showing good progress on expenses is really, really important. And it's not just this quarter, because expenses are going to be a little, probably a little bit higher than what we had anticipated prior to them giving their guidance. But it's the glide path. Are they showing progress? Are those cost cuts and personnel, reductions and simplifications that they've talked about for some time, is that showing up in a better run rate expense figure? And what will the outlook be for the fourth quarter and into 2025? That's going to be important for the story, right, in terms of whether they can get that profitability improvement and do the things that they can control to get that profitability higher.
All right, Saul, you have a busy couple of days coming up. Really appreciate you taking the time to speak to us today. That is HSBC Head of U.S. Financials Research, Saul Martinez. Now, coming up, rising rents and anxiety about the cost of living have been a major issue in the U.S. Up next, a closer look at why housing may be a problem that takes years to solve. This is Bloomberg. This is Bloomberg Markets. I'm Katie Greifeld. The most recent edition of Markets Magazine is covering one of the biggest conversations in the U.S. economy today, housing. Instead of the value of homes dropping too fast, as they did in 2007, they've stayed stubbornly high. Bloomberg's Sonali Basak reports.
There's a housing affordability crisis in the U.S. decades in the making, and both Democrats and Republicans agree it's crimping communities. Home prices are sky high. Affordability in 2024 dropped to its lowest level since at least 2006, according to the National Association of Realtors data. That's just before the global financial crisis popped a housing bubble. Experts target two key reasons. One is a housing shortage, a supply problem building since the 2008 crisis. The U.S. is estimated to be anywhere between 4 and 7 million homes short, according to a report by the Urban Institute. A second concern is that the most dramatic surge in interest rates in a generation has made it hard for homeowners to borrow. But even with the drop in interest rates, the affordability crisis would still be an issue given the extent of the housing shortages. In fact, Bloomberg opinion columnist Connor Sen points out that returning to the kind of housing affordability that Americans enjoyed in mid-2018 overnight would require home values to drop 30% or for mortgage rates to decline to 3%. Needless to say, this isn't very likely. This problem is a centerpiece to election campaign promises. Kamala Harris has promised to address the housing shortage in several ways.
We're going to cut red tape, we're going to work with the private sector, and we'll build 3 million new homes by the end of my first term.
It's a problem Donald Trump is also looking to fix.
Young people will be able to buy a home again and be a part of the American dream. We will eliminate regulations that drive up housing costs with the goal of cutting the cost of a new home in half. We think we can do that.
Trump is also looking to open up federal lands for new housing. The big issue, though, for both parties is that all these plans have significant complications.
Once you run through the practical abilities of all of this, I'm not sure it's really going to be the game changer that I think we would hope it to be.
Wolf recognizes that this problem is hard to fix, but she believes the market will be able to work itself out. Sonali Basak for Bloomberg News.
And for more on this, we're joined now by Bloomberg's Paulina Cachero, who covers housing for Bloomberg News. And give us some context here. How did the U.S. end up in this place where we are in a housing crisis?
Yeah, so, as Sonali mentioned, home buyers today are faced with a bunch of different factors that make it really unaffordable. We are short 4 to 7 million homes in the market, and the high demand over the few available homes in the market has driven prices up to nearly $400,000. That's some of the highest levels in U.S. history. And on top of that, raising mortgage interest rates mean that the cost to get a home loan have increased too. So it's put home ownership out of reach for a lot of people.
Right. Yeah, big time. Of course, you have that structural undersupply of housing coupled with those super high mortgage rates. No one's happy here, but who's hit hardest by that dynamic?
I think when we think about housing affordability, we're seeing that Gen Z and millennials who haven't had the chance to buy are hit the hardest. This cohort they're more likely to rent at a time when the cost to get an apartment has also hit record highs. We've also seen inflation rise at the fastest pace in decades. So they're also feeling the financial burden from every other cost of living, making it that much harder to save up for a down payment.
And we've heard a lot about, of course, the undersupply of housing, that there's just not a lot of homes available. And we have less than a minute left with you. But again, how did we end up here? How did we end up with this housing deficit?
It all started with the Great Recession. That ushered in a decade of underbuilding, leading to the housing shortage that we have now. At the same time, millennials came to prime home buying age. And so there was a lot of competition over, the few homes available. And then we saw the pandemic where record low interest rates, catalyzed a home buying frenzy that pushed home prices really, really high. And now that so many homeowners have locked in a low rate, they don't want to sell.
Right.
And that's contributing and exacerbating the housing supply shortage that we're seeing.
Well, Paulina, we really appreciate you walking through it. Of course, that is Bloomberg's Paulina Cachero. That does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.